If you are over 60, currently working, and planning to claim Social Security, the IRS is quietly setting up a financial trap that could wipe out over 40% of your take-home pay. Right now, in 2026, millions of older Americans are working longer to fight inflation, only to trigger invisible tax penalties that drain their wealth. But there is one specific threshold, a hidden income cliff, that, if you cross it by even a single dollar, will cost you thousands. And almost no one sees it coming until the tax bill arrives. Welcome. Today we are breaking down the exact mechanics of how the IRS penalizes seniors who choose to keep working in their 60s and 70s. We are going to look under the hood of the tax code to show you exactly how the government double dips into your paycheck, your Social Security benefits, and your retirement accounts. I am going to walk you through the major tax traps you face right now, including the infamous Social Security tax torpedo, the brutal Medicare income cliffs, and the devastating combination of required minimum distributions and a working salary. I have structured this so we cover the most common immediate threats first, but you absolutely must stick around for the final point today. In that final section, I am going to reveal a counterintuitive payroll tax illusion that is silently siphoning 7.65% of your income with absolutely zero return on your investment. Let us dive straight into the first major trap. The first massive hurdle you face if you continue to work is the Social Security earnings test penalty. Many Americans decide to claim their Social Security benefits as early as age 62. They want to get some cash flow going, but because the cost of living is so high, they decide to keep their job, or they take up a part-time job. They assume that their Social Security benefit is their money earned over a lifetime, and their paycheck is just supplementary income. But the Social Security Administration sees it very differently. If you claim your benefits before you reach your full retirement age, which is 67 for anyone born in 1960 or later, the government places a strict cap on how much money you are allowed to earn from working. For the year 2026, that strict earnings limit is $24,480. If you earn $24,480 or less, you are fine. You get your full paycheck and you keep your full Social Security benefit. But the moment you earn a single dollar over that limit, the penalty kicks in, and it is a steep penalty. The Social Security Administration will deduct $1 from your benefits for every $2 you earn above the $24,480 limit. Let us walk through the exact mathematics of how this works so you can see the danger. Imagine you are 63 years old. You are collecting a modest Social Security benefit of $1,500 a month, which is $18,000 for the year. But to pay for groceries, property taxes, and utilities, you take a job that pays $45,000 a year. You might feel like you are finally getting ahead, but let us look at the math. Your $45,000 salary is $20,520 over the $24,480 limit. Because the government takes $1 for every $2 over the limit, they are going to penalize you exactly $10,260. But here's where the trap snaps shut. The Social Security Administration does not just send you a bill at the end of the year. They withhold your actual monthly checks. In this scenario, they would completely withhold your $1,500 check for January, February, March, April, May, June, and July. For 7 entire months, you would receive absolutely nothing from Social Security. You are working hard at a job, paying taxes on that labor, and the government responds by completely turning off your retirement income for over half the year. Did you know that the Social Security Administration currently withholds billions of dollars annually from working seniors who simply did not understand this math? It is a staggering reality. Now, the government will tell you that this money is not technically lost forever. They tell you that once you reach your full retirement age, they will recalculate your monthly benefit upward to account for the months they withheld your money. But that recalculation takes years to break even. In the immediate present, you are suffering a massive cash flow crisis. You are working to get ahead, but the system is forcing you to tread water. There is a slight reprieve in the specific year you reach your full retirement age. In 2026, during the months leading up to your birthday in that specific year, the earnings limit jumps to $65,160, and the penalty drops to $1 withheld for every $3 earned over the limit. Once your birthday month arrives, the earnings limit disappears entirely. But for anyone under that age, working a steady job while collecting benefits is a mathematical nightmare. However, the earnings test is just the beginning. The second trap is far more insidious, and it affects you regardless of whether you have reached your full retirement age or not. It is known in the financial world as the Social Security tax torpedo. This is the mechanism by which the IRS decides how much of your Social Security benefit is subject to federal income tax. To understand why this happens, we have to travel back to 1983. Back then, Congress decided that Social Security benefits should no longer be completely tax-free for everyone. They created a formula based on something called provisional income. Provisional income is your adjusted gross income plus any non-taxable interest you earn from municipal bonds plus exactly 1/2 of your Social Security benefits. If your provisional income crossed a certain threshold, up to 50% of your Social Security became taxable. 10 years later, in 1993, they added a second threshold, dictating that up to 85% of your benefits could be taxed. Here is the absolute tragedy of those 1983 and 1993 laws. Congress never indexed those income thresholds for inflation, not once in over 40 years. In 1984, less than 10% of retirees paid taxes on their Social Security. Today, because of inflation and wage growth, the vast majority of seniors are ensnared in this trap. Let me ask you a question. When you paid into Social Security with after-tax dollars out of every paycheck for 40 straight years, did you ever imagine you would be taxed again on the return of your own money just because you decided to work a part-time job in your 60s? It feels like a fundamental betrayal of the promise of the system, but it is the law of the land. Let us look at the 2026 thresholds. If you are filing as a single individual and your provisional income is under $25,000, your Social Security is tax-free. If it is between $25,000 and $34,000, up to 50% is taxable. If it is over $34,000, up to 85% is taxable. For married couples filing jointly, the bottom threshold is just $32,000, and the top threshold is an incredibly low $44,000. Think about how easy it is for a working couple in 2026 to shatter that $44,000 limit. Suppose you and your spouse are receiving a combined $36,000 a year in Social Security. Half of that is $18,000. Now suppose one of you works a job making $40,000 a year. Your provisional income is your $40,000 salary plus the $18,000 from Social Security, which equals $58,000. You are miles above the $44,000 threshold. Because of that modest $40,000 salary, the IRS is going to drag up to 85% of your Social Security, which is $30,600, right onto your tax return as ordinary income. You are now paying federal income tax not just on your wages, but on the retirement benefits you are desperately relying on. And the 2026 tax brackets offer very little shelter. With the standard deduction for a married couple sitting at $32,200, a massive chunk of your working wages and your Social Security will be subjected to the 10%, 12%, or even 22% federal tax brackets. You work to get extra money, but the IRS just expanded the size of the target on your back. This brings us directly to the third devastating trap for working seniors. It is an acronym that strikes fear into the hearts of retirees everywhere. IRMAA. IRMAA stands for the Income-Related Monthly Adjustment Amount. This is a surcharge added to your Medicare Part B and Part D premiums if your income exceeds certain levels. You might think that because you are over 65 and on Medicare, your healthcare costs are relatively fixed. But Medicare premiums are strictly tied to your tax return. Specifically, the government looks at your modified adjusted gross income. But here is the catch. They look at your tax return from 2 years ago. This is called the 2-year look-back period. Your income in 2026 will directly dictate the Medicare premiums you are forced to pay in 2028. Picture a staircase. Unlike normal federal tax brackets, where you gently walk up a ramp and only pay a higher rate on the next dollar you earn, IRMAA is a steep, unforgiving staircase. If your foot slips and you land just 1 single inch onto the next step, your entire body goes up. It is a cliff penalty. If you are married and your modified adjusted gross income is under the base threshold, you pay the standard Medicare premium. But if you work a job or pick up extra shifts or get a year-end bonus that pushes your income just one single dollar over that threshold, you do not pay a tiny bit more. You fall off the cliff. That single extra dollar of income can trigger an IRMAA surcharge that costs you and your spouse over $2,000 in extra Medicare premiums for the year. I want you to really think about that. Imagine taking a few extra overtime shifts in November to help pay for your grandchildren's holiday gifts, earning an extra $500, and as a direct result, receiving a letter from the government stating that your Medicare premiums are going up by $2,000. Your effective tax rate on those extra shifts is over 400%. It is mathematical insanity. Consider this staggering reality. The government has an appeals process for IRMAA called Form SSA 44. If you have a, quote, life-changing event like a divorce, a death of a spouse, or a complete work stoppage, you can appeal the surcharge. But do you know what is explicitly not considered a life-changing event? Continuing to work. If your wages push you over the line, the government offers zero sympathy and zero exemptions. They view your working income as proof that you are wealthy enough to subsidize the Medicare system, regardless of the inflation hitting your grocery bills or the property taxes threatening your home. In just a moment, I am going to break down the absolute worst trap of all, the payroll tax illusion that actually makes it mathematically irrational for some individuals to continue working after 60. But before we get to that, we have to look at what happens when the IRS forces you to take money out of your retirement accounts while your boss is still paying you. This is the fourth major trap, the collision of required minimum distributions and a working salary. In the modern economy, people are living longer, staying healthier, and frequently choosing to work well into their 70s. It provides mental stimulation, social interaction, and vital financial security. But the IRS's patience has a strict expiration date. Under current law, once you reach age 73 or 75, depending on your exact birth year, the government mandates that you begin draining your tax-deferred retirement accounts. These are your traditional IRAs, your 401ks, and your 403bs. You received a tax deduction when you put the money in decades ago, and the money has grown tax-free ever since. The IRS has been waiting patiently for their cut, and at age 73, they stop waiting. You are forced to take a required minimum distribution, or RMD, every single year based on the Uniform Lifetime Table. Let us look at how this destroys the tax strategy of a working senior. Suppose you are 73 years old. You enjoy your career, so you are still working and earning $80,000 a year. You also did the responsible thing throughout your life and saved up $1 million in a traditional IRA. According to the IRS formulas, your first RMD will be roughly $37,700. You do not need that $37,700. You are living perfectly fine on your $80,000 salary. You want that money to stay in the market, compounding and growing for your spouse or your children. But the IRS forces you to withdraw it anyway. Now, let us look at your tax return. You have $80,000 in working wages. The IRS dumps a $37,700 forced distribution on top of it. Your income just spiked to $117,700. Because the standard deduction for a single filer in 2026 is $16,100, the vast majority of your income is entirely exposed to federal taxation. That forced distribution is dumped straight into the 22% or even the 24% federal tax bracket. You are losing a massive chunk of your life savings right off the top, not because you spent it, but simply because you chose to keep working. Now, some financial advisors will quickly point out the still working exception. This is a rule that says if you are still working at age 73, you can delay taking RMDs from your current employer's 401k plan until you actually retire. But what they often fail to explain are the massive hidden caveats. First, this exception does absolutely nothing to protect your traditional IRAs. If you rolled over old 401ks from previous jobs into an IRA, all of that money is fully subject to RMDs, regardless of how many hours you are working today. Second, if you happen to own 5% or more of the company you work for, the exception is void. The IRS forces you to take the distributions anyway. You are trapped in a high-income collision course, combining peak working wages with forced retirement withdrawals. This brings us to the fifth, Final and most infuriating trap of all. This is the one that is almost entirely misunderstood by the general public. I call it the FICA sunk cost trap. Every time you get a paycheck, you see the deductions: federal taxes, state taxes, and FICA. FICA stands for the Federal Insurance Contributions Act, and it is the mechanism that funds Social Security and Medicare. The employee side of this tax is 7.65%. 6.2% goes to Social Security, and 1.45% goes to Medicare. If you are self-employed as an independent contractor or consultant, which many seniors are, you have to pay the employer side too, bringing the total self-employment tax to a crushing 15.3%. When you are young, paying into FICA makes logical sense. You are building your work history, earning your quarters of coverage, and increasing your future Social Security benefit. But the Social Security benefit formula is based on your highest 35 years of inflation-adjusted earnings. We call this your average indexed monthly earnings, or AIME. The administration takes your top 35 years, indexes them for inflation, and calculates your payout. If you are 65 years old, there is a very high probability that you have already worked for 35 or 40 years. You already have a full earnings record. Now imagine you decide to step back from your stressful corporate career and take a more relaxed part-time job earning $40,000 a year. Because you are earning wages, the government is going to extract that 7.65% FICA tax right out of your paycheck. But here is the devastating reality. Because your new $40,000 salary is lower than the inflation-adjusted salaries of your peak earning years in your 40s and 50s, this new year of work replaces absolutely nothing in your Social Security calculation. It does not knock out a zero. It does not replace a low-earning year. It is mathematically invisible to the Social Security formula. You are paying a 7.65% tax, or 15.3% if you are consulting, for absolutely zero future benefit. It is a pure sunk cost. You are throwing money into a black hole. You are paying for a ticket to a show you have already paid for, and the government is more than happy to keep selling you the ticket. Let us stack the sheer mathematical weight of all these traps together to see the true reality of working over 60 in 2026. Imagine a 66-year-old consultant who decides to keep taking on client work. They are subject to 15.3% in self-employment taxes that provide no boost to their future benefits. Their working income causes the Social Security tax torpedo to fire, dragging 85% of their benefit into taxable income. This combined income pushes them into the 22 or 24% federal tax bracket. On top of that, they have a 5% state income tax. And finally, the extra consulting income pushes their modified adjusted gross income over the cliff, triggering a $2,000 IRMAA surcharge for Medicare. When you add the self-employment tax, the federal income tax, the state income tax, the taxation of their Social Security benefits, and the IRMAA penalty cliff, the effective marginal tax rate on their consulting work can easily exceed 60 or even 70%. They are doing the work, taking the stress, putting in the hours, and keeping maybe 30 cents on the dollar. The IRS is taking more than you think. They are taking almost all of it. The system relies on the fact that the tax code is too complicated for the average person to map out on a whiteboard. They rely on the fact that you will just look at your hourly wage and assume you are getting ahead. But the reality is that the combination of the earnings test penalty, the provisional income formula, the IRMAA cliffs, the RMD collisions, and the FICA sunk costs create an environment that is actively hostile to working seniors. Let me summarize exactly what you need to take away from this today. First, if you claim Social Security before your full retirement age, be acutely aware of the $24,480 earnings limit, because every $2 over that line costs you $1 in benefits. Second, understand that your working wages will almost certainly push your provisional income over the incredibly low $34,000 or $44,000 thresholds, guaranteeing that 85% of your Social Security is taxed. Third, remember the 2-year IRMAA look-back. The extra shifts you work today could trigger a massive Medicare penalty cliff 2 years from now. Fourth, if you are in your 70s, you must proactively plan for the collision between your working wages and your forced IRA distributions. And finally, recognize that if you already have 35 years of solid work history, the FICA taxes on your current wages are a pure sunk cost yielding zero future return. You have worked your entire life to build your nest egg. You are the backbone of this economy, paying taxes year after year, decade after decade. You deserve to keep the money you have earned, and you deserve to understand the rules of the game the government is forcing you to play. Do not just hit subscribe and move on. I want to hear from you in the comments. Have you been hit by the Social Security tax torpedo? Did you get a surprise IRMAA bill in the mail because you picked up extra shifts at work? Drop your experience in the comments below so others can learn from what you went through. Thank you for watching, and I will see you in the next one.